This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome to the Money Seed Podcast. He's Chris Ferguson. I'm Gabriel Store. Thank you for joining us here on episode 1. And in this podcast, we are talking about investing, everything about investing. And this being episode 1, I think probably a logical place to start, Chris, is just maybe some introductions and how we got into investing. And why don't you kick us off?
Gabe, thank you so much for the intro. This is the first episode of this podcast. So I'm excited to see where this will go. To start off, a little bit of background on myself. I am board certified anesthesiologist and pain physician. So I have a reasonable income. And why a lot of people would ask is, why are you doing an investing podcast? It seems like you should be able to just put your money in a 401k plan, do the standard Dave Ramsey approach of pay off all your debt, stick your money in the bank, max out 401k plans, etc. And at least in my experience, I get to talk to a lot of people that are older. There are a lot of physicians, lawyers, etc. that I interact with socially. And I just like to see how they've approached their life and learn lessons from those that have lived a full life. And there are a lot of people who did not do well with investing in traditional 401k plans, etc. I know that's a very, and again, so we're going to start this podcast with, this is just our investing philosophy. This is what we're doing. We're not telling anyone what to do. This is just what we do. So I know that's standard advice that you should just max out those 401k plans. And if you have kids, the theory is you invest in one of those investment vehicles and you stick the money in the stock market and you just let it ride over time and have it pay for your kid's college fund. There are also plans like whole life insurance, etc. There are all these plans, and it seems like the people who benefit the most from these plans are the people who own the plans. And there's some investment groups that I think do really, really well for their investors, especially if they're really busy. But the standard large investment vehicles, I know a lot of people who've invested them and they have not done well at all. I know a lot of people personally who've done phenomenally well with small businesses or with real estate. So that's what launched my interest in investing, because instead of just working for money, if I have money sitting in the bank, ideally I would have it working for me. Gabe, what about you?
Yeah, no, I agree with everything you said. So there's a couple of things on my side personally that really got me interested in investing at an early age. So I've always been good with numbers. I'm an engineer by training, and I worked as an engineer for a few years. And about 10 years back, I left the engineering world, and now I'm more into supply chain, where I deal with even more numbers. And there's one thing that kind of always scared me, and this is like at the lowest level of why I invest, is I am petrified of being like 75 or 80 or even 85 years old and not having any money and just relying on a social security check or some kind of handout from the government. Living in poverty in my later years scares the Jesus out of me. And so I've always thought, okay, how can I avoid that scenario? Because there are, poverty, amongst retirees is a real thing. If somebody is struggling with poverty and they're in their 30s or 40s, you have your energy, you have your strength, you have your health, you can get a second job, part-time job. There's hope. If I'm 75, 80, 85, I probably will not have any opportunity or energy to work. And so I definitely want to avoid that scenario. So that's number one. But on a much sort of more practical level, I have dreams, right? Everyone has dreams. I have dreams. And I'm big on travel. I still have that starry-eyed thing. I want to travel. I want to go out there. I want to see the world. And I think 401ks are great. But deep down inside, I know that if I go to work, I get a paycheck, put some money in 401ks, I pay my bills, and I put some money away for the kids for college, I know I'm going to be a good husband, a good father, it's fine. Things will be okay, but I won't get to live my dream. Like that plan is not going to be enough for me to see my dreams through. And that's why I've been restless for the past 10 years or so, thinking, how else can I have income in my older years? How else can I unlock passive income? And how else can I grow my wealth faster than just the traditional method? So I personally believe the 401k plan. I'm not criticizing 401ks. I think they're great. I put money in my 401ks, but I don't believe 401ks were designed to create wealthy people. I think 401ks were designed to keep people off poverty. Is just to keep people out of poverty in their older years. So I really don't believe that just going to work and putting money in your 401ks is going to lead to any kind of financial independence. It's going to lead to a slightly higher quality of life when you're in your 60s, 70s. It's not going to lead to financial independence. You want financial independence, like I do, and I'm not there yet, but I have a plan and I have dreams. But if you have those dreams, if that's what you want to go, you need to do something else. You need to take on more risk. You need to educate yourself a little bit about investing, and you gotta take a step in that direction and just go for it.
And I think what's important is, like you said, you're an engineer, you're good with numbers. I think it's important to know what your strengths are and what your weaknesses are. So if you're not someone that can invest by understanding the numbers and making just really emotionally detached decisions that are really in your financial best interest, or if you get emotionally hung up on things, or if you just don't have the time or the effort to really understand what the investment path you're dealing with, then you should understand what, again, your strengths and weaknesses are. And maybe you shouldn't be the driver of investing, but maybe then you should pick people or groups that you figure out, is this a good group? And if you like it, then you invest with them. Because there's some people that want their money to grow, but they just either don't have the time or the aptitude for it. Because I think it takes us just an emotional predisposition to have the discipline to really invest in something. And it's one thing if you show up to a job and you work and you know you're getting paid, you're getting a set paycheck at the end of the month. It's a different thing when you're investing in, say, the stock market, or you're investing in property or a business, and that requires just an entirely different skill set. Because if you're working, someone has put together all the pieces of that business for you to show up and work. If you're driving it, you have to keep all those other things in mind, and that takes a lot of mental energy. So I don't think this is for everyone, and you should just understand what your predilections are.
And thank you for saying that. I agree. It's not for everyone because, first of all, human beings psychologically are extremely risk averse, right? Like human beings, if you ever listen to them, like all we want to do is avoid risk. As soon as you start mentioning the word investment to somebody, the first question on their mind usually is, how much can I lose, right? It's not how much can I gain or, where I'm going to be in 10, 20 years and why. It's how much can I lose? Everyone is so petrified of the downside, the risk. And so, yeah, I mean, this is not for everyone. And some individuals, sadly, don't evaluate risk properly. And some individuals are really hung up on some scary stories that they heard from their friends or their uncles or their brothers-in-law, whatever, right? And so a lot of people, yeah, investing is just not for them, right? And that's why, for example, 401ks or mutual funds or those products, they're designed to take the risk off your mind, right? Because it's almost like you're asking someone else to make those decisions for you. It's like, I'm just giving that person my money, and the mutual fund has this, superstar fund manager, and they're going to make all these decisions with my money, and they're good decisions. They're much better than any decision I could make. And therefore, it's almost like I'm passing the risk onto someone else, and I sleep better at night, right? Because I'm not going to make any dumb, idiotic mistake with my money. And so, yeah, the whole mindset has to be different. And I think that starts with education. So our education system here in North America, and actually in many parts of the world, was designed like 150 years ago, and it was designed to create worker bees for the Industrial Revolution, right? Factories were popping up everywhere. People needed skills, and we are good worker bees. Like if you succeed in school, you are basically trained to become a good worker bee. And we are not teaching our kids how to be entrepreneurs. We're not teaching our kids how to properly evaluate risk. We're not teaching our kids how to even calculate their monthly mortgage payment, right? And it's just investing is not something that we learn the way we learn ABCs and 1, 2, 3s. And so that's why most people stumble on investing in their 20s and 30s, maybe even 40s. And it's not a simple road. It's not something like how you learn how to read and write. Like it's complicated, and you're gonna have some good days with investing, some bad days with investing. You're gonna learn some expensive lessons along the way, but in the end, I mean, I'm totally for it. I'm totally in the camp where, like, yeah, investing makes sense. Like everyone should understand the basics of how to invest and why we invest and why this is such a good thing.
So to follow up with what you were just saying, I 100% agree. So I feel like I'm really qualified to comment on this because my undergrad was I did a combined science and teaching degree. So I have a teaching degree and I fully understand how the teaching system works. And I have a lot of respect for teachers. It's a very difficult job. But I 100% agree with you. What the school system is really designed to do is to make you a good worker. The people who succeed in school are and I'm a physician. I've scored very well on my standardized tests. I had to score very well on lots of standardized exams to do what I do. And you want that. You want people who are physicians taking care of you to really understand what they're doing. However, to do well in school, you have to be really good at being told what to do. Like you're given a set of information. Your job is not to question that information or think deeply about it. Your job is to memorize it and then put it back on a page. If you're taking a standardized test, your job is to figure out what will be on that test and then regurgitate it on the standardized exam. And there are some people that are really good at that and some people are not good at that. And school, for better or worse, screens for people that are really good at being told what to do and how to replicate the information they're given. Entrepreneurship or even starting a podcast is totally different. Like even coming up with the name of this podcast, no one's grading us. No one's telling us. First of all, no one told us to start a podcast. And then even the process of coming up with a name for the podcast, like there's no grade for it. It's just like come up with a name and that's the name.
That's exactly it.
And then if people listen to it, then it was a good name. Or maybe we have good information. Or if no one listens to it, then it wasn't a good name. Like it's really a very objective way to figure out what you're doing, if it's working or not working.
Exactly. And it's trial and error. And there's no magic to it. Like you said, there's no formula that you can follow the way you can follow formulas in school. Like, yeah, follow this formula and you will pick the best name there is and follow this formula and your podcast will be the most successful one on iTunes. No such thing. And investing is very similar to that.
So to touch on that, so Gabe and I have been friends and business partners for a very, very long time now. We became friends, just for anyone who's listening, way back in our college days, which is a very long time ago. So I'm just going to give a brief synopsis of an investment that we kind of worked through together. And I think it's a very good example of why sometimes you have to do contrary what everyone says in order to do well. So the date of this recording is October 2021. So about a year ago, approximately, COVID hit, all of the stock markets crashed, and the airlines were hit particularly badly. And I thought, well, there has to be an opportunity here. And Gabe has an MBA, so we sat down and he talked me through, and we looked at all of the financials of all the airlines. And some of them were very, very solvent. So I called financial advisors that I knew, and these are personal friends of mine. And I said, I'm thinking about investing in airlines. And they said, that is the dumbest idea I've ever heard. Don't do it. And then I called a few other doctors I know, lawyers I know, business people I know. And actually everyone said, this is the dumbest thing you can ever do. Like, leave it to the professionals. Don't touch it. But of course, Gabe and I, I'll speak for myself. What I did was I figured out how much money I could totally afford to lose. Like if I lost all this money, then everything would be fine. But I figured out, I maxed out how much money I could lose. And then we split it amongst 4 different airlines. So if one airline went under, at least we'd have 3 other airlines that would do really well. And fast forward a year, I've doubled my money. And that was a very calculated thing. And it was not a small amount of money. But I remember a few days into this, my wife told me, she's like, oh my God, Warren Buffett dropped all of his airline stock. What's wrong with you? Like, the best investor theoretically in the world is doing the opposite of what you're doing. And I said, I don't care. We're right. Like, I don't care. And I remember calling you and be like, Gabe, what is going on? And we held the stock and we did well with it.
Yeah, exactly. And I think you just said so many things there that are worth talking about. So number one, just to put a timeline onto it, I think the COVID crash started happening early March of 2020. Mm-hmm. And you and I spoke very briefly after, like, I mean, the whole market kind of tanked in a matter of maybe a week or two. And then right, like toward the end of March, early April, when it was like near the bottom and it has been tanking for several weeks, that's when you and I talked about the airline stocks, right? So that's when I think you bought in. And it wasn't until, you bought in. And then a few weeks later, maybe a month later, is when Warren Buffett gets out. And, this gets back to the whole risk aversion panic thing I was talking about 10 minutes ago. A lot of investors at that time would have panicked. They're like, well, if Warren Buffett's getting out, it's time to panic. I'm getting out. And first of all, kudos to you for leaving your money in the market.
Right? I think yours was there as well. And I think you left it, didn't you? We both left it.
Correct. You held on to it longer than I did. Kudos to you for that one. But that's the thing. Like, first of all, like, that's something you have to learn, right? Like, not to panic, because panicking when you're investing is just the worst thing you can do. You're always going to make a bad decision if you start panicking. Like, no need to panic. Number two is you had a bit of diversification, right? You diversified your investment between 4 different airline stocks, right? It's much better than just putting it all into a single airline stock, right? Because you were diversified 4 ways.
Yes.
So if one of those airlines would have had some kind of unexpected, air crash or disaster or something, and they would have went bankrupt, like, you still had 3 solid airlines left. And so don't panic, diversification, wait until the market rebounds. Like, the American stock market has a fantastic history. It's much better than the history of, say, the Japanese stock market or any other stock market. Like, in America, you put some money in the stock market, you wait 10 years, it's going to be higher. I don't think you can find a single 10-year period in American history where a stock market was lower 10 years before like a certain date. Like, any 10-year period you pick, at the end of the 10 years, it's higher than it was at the beginning of the 10-year period. And that's amazing. That's an amazing track record. So just like, hang in there, don't panic, you'll be fine.
And I don't make a habit of regularly investing in the stock market, but I think when there are specific instances where, with a reasonable degree of certainty, there's a very undervalued stock, that's when you put your chips in and you're like, this is what I'm betting on.
Exactly. Make an educated decision, go with it. And, people always think that if only I think more about it, I think more about it, I can just reduce risk. And that one, it's true for the first like 10 minutes, but after a while, there's no point. Whether you think about it for 20 minutes or you think about it for 20 days, I don't think there's any advantage to thinking 20 days or 20 minutes. Like, think about it a little bit, assess your situation, figure out how much risk you're comfortable with, and just go with it. But yeah, I was going to say you did really well, and again, kudos to you. Like, the whole market was running for the doors, running for the exits, and there you were betting on airlines, and here you are a year later with a portfolio that's up over 100%. And just to put that into perspective, the stock market that's doing like 7%, 8% a year, which is what the S&P 500 or the American stock market does on a long-term basis, is about 7%, 8% a year. It takes like 8 or 9 years for the stock market to double. Like, if you would have put that money into just like the S&P 500 or some other random mutual fund, you would have had to wait like 8 years or 9 years for that money to double. You did it in 1. So congrats, man. That's awesome.
Well, and I think this is why this highlights the difference between school and the real world, is because I can call you up and say, Gabe, I know you're really good at this. Talk me through the financials. You talk me through I'll give you full credit. You looked at all the spreadsheets, and I picked the airlines based on, and again, we're all adults here. So I invested, and if it went south, this would be my call. Like, I just take advice, but if it went south, I was going to own that decision. This would be my fault, no one else's. But you helped me go through the financials of every single one of those companies, all the different airlines, and then we picked the ones that were the most solvent. So it wasn't like I was randomly guessing. But if this was a school assignment, I would have to do this on my own. But in the real world, you figure out which people have the strengths that you don't have or the complementary skill sets, and then you use those for a huge upside.
And I think we live in a very exciting time because it has never been easier for anyone to educate themselves than it is now. I mean, you got the internet, you have YouTube, there's so much good free information available. You talk about like bringing up the balance sheets and the financial statements of the airlines, all that's available. Like, you click the mouse a few times, it's all there, it's all free, it's all available. If you were to go back, say 20, 30 years, right? It was very hard to get the information you needed. The information wasn't up to date. This was, the internet wasn't there. So you had to probably dig up like, I don't know, the Wall Street Journal or something at the library, or you would have had to buy an expensive book, or heaven forbid, you had to order these tapes online, for like this $900, stock trading course that, you have to listen to the tapes for like 3 months. None of that is needed today. Today, the information is out there. It's free. You just need to find the time and educate yourself, and anybody can learn anything. It's amazing. It blows me away how easy it is to learn anything. For example, I'll give you an example. Last year, during the COVID crash, so a year and a half ago, I was home like most Americans were home, right? We're hanging out, and I had a lot more free time than I usually did. And so I got into options trading. That was the first time in my life I ever traded an option. Prior to that, I've heard about it. I didn't know much about it. And sure enough, I found podcasts, I found YouTube videos, I found free ebooks, and I educated myself, and I've done great with it. I mean, it's like
I'm going to be nosy. How great have you done?
Okay, so if you're ever bored, you can check out my YouTube channel. I don't have a lot of subscribers yet. I just do it mainly for fun. But there you can see every single trade. So every single trade I do in my options account. I started it last year, toward the end of the year. So like November, December of 2020. And let's see, the year to date profit right now is just over $2,000. And I started with $17,000. So I'm like maybe 13, 14% up so far this year, right? The first 10 months of the year, 9 months of the year, whatever. I'm up, 14%, which is pretty good.
That's very good.
That's very good. So options are a bit of a different beast from stocks. So my goals are higher. Like if I'm investing in stocks, my goal is like 10% a year. If I'm investing in options, it's 20%. So my personal goal, and this is what I say on that YouTube channel, it's called 7-minute options. Check it out. But it's 20%. So I'm going for 20% a year. This is the first year I'm doing it. I hope I can get there. But even if I can't, I'm pretty confident next year, the year after, I'm going to hit my stride. And I think 20% for me long term there is doable.
So if anyone that's listening to this, if you're not familiar with investing, and anyone can, like, Gabe, jump in if I'm wrong, but I think like Warren Buffett or those top flight investors, they average, I think, between like maybe 15 to 17% every year.
That's on the high end.
That's like super high end.
High end, yes. Correct.
Which is not the average, but that is very high end. So for anyone that's listening, when you're saying you're looking for like 20% annual returns, that is an exceptionally good return.
That is very aggressive. And I haven't reached it yet. I mean, that's a very aggressive target. But even if I don't reach 20 and I get 15 or 14, I'm still doing very well. And I'm still very happy with that. But you're right. So yeah, just and thank you for bringing that up. You're right. So most of the famous investors you've heard of, like the Ray Dalios and the Warren Buffetts, they get like 15%. Like that's a very good year for them. And long-term, they do better on good years, but they do worse on the bad years. But as a long-term average, you're right. Like if they can do 15% long-term, that's phenomenal. Most of them do, like you said, between 11 and 12 on the low end to maybe 16, 17 on the high end. And if you want to go with mutual funds, they're a little bit
let me just jump in on that one. So I just Googled Ray Dalio. So Bridgewater Associates, Ray Dalio, who is considered one of the best investors of all time, his fund averages about 12% annually since its existence. and its all-weather fund has returned 7.8% with positive returns for the last 18 years. Now, that's very impressive because he's getting these positive returns every year, but the percentages are 7.8 to 12%.
Right. And I think it's worth noting at this point is that's what the fund returns, but you get a little bit less. So if you were to invest your money with Ray Dalio takes a cut because he's managing the fund, right? And the management ratios run anywhere from half a percentage point all the way up to like 2 percentage points. So, for example, the fund gets 10%, let's say, but you as an investor, you actually have to give up 1%. That 1% is what Ray Dalio takes to run his company. So the fund does 10, the fund takes 1%, you only get 9. And 9 is still good. I mean, 9 is still good. You can still have a very nice portfolio with 9%.
And if you have, I mean, 1% is not a ton of money that's coming off. Like it is 1%, but it's still 1%.
It's very significant. People think, oh, what's 1%? It's nothing. So no, it's 1% of your entire portfolio. And we're gonna, like, in future episodes, I'll do some numbers. I'll do some calculations to show that's very significant. Like if you invest over 30 years and we invest the same amount of money and you get a 10% return and I get a 9% return, that 1% difference is going to be like a huge difference after 30 years. Like we're talking like more than $100,000 difference. Very significant. It doesn't sound like much, but after 30 years, you add it up and, you know, the magic of compounding, it becomes very significant. I mean, that's why Ray Dalio was a billionaire. Come on, if it's not much, how did he make his billions, right?
Exactly.
But and here's the other thing I want to say is, you know, people, every time I talk about investing, you know, like getting back to the whole psychology, people always say, well, what if you lose and how much you're going to lose and blah, blah, blah. And it's like, yes, but there are no guarantees. Like even if you buy a mutual fund with Ray Dalio or Warren Buffett or any one of these fancy sounding banks, they never, ever guarantee anything, right? So you pay them that, you know, 1% of your portfolio. You have a $100,000 portfolio and you're paying them like $1,000 a year. They guarantee nothing for that. Like, yeah, if the stock market crashes and you lose half your portfolio, they say, oh, you know what? Too bad, Chris. They don't guarantee anything. So be very careful. Just because you're investing with some superstar doesn't mean you're not going to, you know, lose. Your fund's not going to have a bad day. So yeah, you have to be aware of the risks. Nobody can get out of the risk with investments. Don't ever fall into that trap.
Well, and I think I'm really looking forward to seeing it because Gabe and I are actively investing. So the goal of this podcast is really just to share what we're doing. And usually we end up talking about Gabe and I end up talking about our investments and what we're doing with them. And then we have several investments together. So the purpose of this podcast is really just to share what we're doing for anyone that's interested. I was talking to someone else and they said, well, I'm not going to really invest in the stock market. I'm not going to invest in anything. I'm just going to take my money and put it in the bank. And I tried to explain this, but they just couldn't get their head around it, that if you just have your money in the bank, you're actually losing a couple percentage points every single year because of inflation. Every year, inflation is around 2%. So you're losing 2% of your money every single year just because it's worth less. It just goes away. And I don't think people really can get their heads around that. Like back in the day, if you were going to buy a bottle of Coca-Cola, I remember when it was 50 cents. And now the same bottle is probably like $2 something. So your money is just worth less over time. So unless you put your money into some sort of vehicle to keep up and ideally surpass inflation, it's just being eroded away over time.
Yeah, that's exactly it. That's exactly it. You know, you put your money in the bank, the savings account you have, they might pay you 0.5%, 1% interest, maybe on a good day. And like I said, inflation is 2.5. You're losing money every year. Yeah, everyone has to have a little bit of money in the bank just for like a rainy day fund kind of thing. But that is not an investment. That is the opposite of investment. Like you said, it's you're losing money every year, guaranteed to lose money every year. So
well, and it's kind of interesting because I know a lot of people who, specifically in my social circles, that will their retirement plan is their 401k plan, and they're making a very good living, and they're putting all their money in a 401k plan. But I personally know people who didn't even go to college, and they started investing in real estate, and they're doing financially way better than I am, way better than any of my friends are. They don't have a boss to go to. Like, they have their own real estate company, and they're very happy. There's no burnout, like very, very, very happy. So several years ago, this is my first investment property. It was actually in Canada, and I was recommended. Her name's Tahani, and she is in Ontario. And we have another podcast, Get Healthy 360. So I interviewed her. So she was my real estate coach / realtor. So she talked me through how to invest in that first property. And it was a lot of learning. Every time you invest in something, there's a lot of learning. And I dealt with my first tenant and tenant issues and assorted other things. And I think I was all in for probably $80,000 with it. And then after about, say, 4 or 5 years, I ended up selling the property. I got all my money back. I ended up profiting an additional $80,000.
Amazing.
That was a phenomenal return.
Amazing.
A phenomenal return. And then I co-invested actually with my mom. So we split the profit, and still on a $60,000 investment, $60,000 to $80,000 investment. I'm foggy on the details, but my mom got $40,000. I got $40,000, and we set up the company structure just right. So that minimized taxes. And then I got really interested in real estate because that was way better than anyone else's 401k plans.
Amazing. Exactly. Totally. And that money is available to you, right? Whereas once you put in the 401k, again, you are heavily incentivized to not touch that money and to not pull it out. You want to pull money out of your 401k for whatever reason before you're, retired. It's going to hurt, right? Whereas with your investment, that's your money. You can touch it, you can use it, it's much more liquid, much more accessible than in a 401k.
And then so there's another podcast, Get Healthy 360, that it had these occasional financial episodes. And then Gabe and I decided to just split it. So we would just have a financial podcast that we'd both be a part of. And then Get Healthy 360 would just be just medicine. But there was another physician I interviewed, and he said he never made more than $200,000 a year. That was his best year as a general surgeon, which in the scope of being a surgeon, that's low. But he lived below his means, but he worked, I think, 9 months out of the year and took 3 months off and had a very nice quality of life. But his entire investment strategy and his entire retirement plan was he bought 4 apartment complexes, and that's it. He didn't do any crazy real estate strategies. All he did was he just bought them and let them pay themselves off. And then he retired, I think, around 50-ish, something like that. And he's making net more now off those 4 apartment complexes because over time, the rents have gone up because of inflation, and the buildings have gone up again because of inflation, and they've been all paid off. So he has a very, very, very comfortable retirement. Whereas I know of lots of people who have just put all their money into a 401k plan, and it just hasn't kept up with, again, inflation. So they have to work into their retirement. Like, they can never stop working. And what I would be worried about is what if they can't physically work?
Exactly.
Then where do they go? They become homeless, which is a really sad place to be.
That's exactly it. Yeah. And yeah, so thank you for bringing up real estate. So, I was doing some internet searching on the statistics behind wealth and, that kind of thing. Real estate has made more millionaires in America than any other type of investment. So out of all the households in America, here's a question for you. So in America right now, there are 330 million people spread across 123 million households. Out of those 123 million households, how many households do you think have a net worth above 1 million?
I'm going to say 10%.
Very good. Wow, very good. So it's 11%. So you were like dead on. 14 million households. Roughly, 1 in 10, let's say 11%, 1 in 10 households have a net worth above 1 million. Most of that was because of real estate.
But I'd be willing to bet that it's asymmetric because you have a lot of people with not a lot, and then a few people who have a lot more. But I think that's because of choices they make. As a quick segue, I think a lot of people want to blame the government or the political party or all these other things because it takes away responsibility from them. Like, I don't want to watch a lot of TV. There's not a lot, like, I don't have a lot of like, I'm just going to sit around and kill time. Like, I don't kill time. Like, I will like do whatever I can to save my time because if you have downtime, I would say use it productively.
Yeah, exactly. And there's no need to get political on this show. I don't want to get political, but so I will say that I think that one of the main reasons why real estate has made more millionaires is because people are comfortable with real estate, right? Most Americans at one point in their life will either live in a house or will buy a house. And so we're comfortable with buying houses. We know houses. We know somebody who's bought a house. It's not that complicated. I think the whole process is it's made in a way to make it easy for Americans to buy a house, whether you want to live in it or you want to buy it as an investment property. It's not complicated to buy a house. And so people look at it, oh, I want to invest my money. Stock market looks complicated. Start my own business looks hard. Real estate, you know what? Yeah, I've bought houses before. I've sold houses before. It just doesn't seem as daunting as other investments. And it's just, and like you said, there's so many ways real estate works. One, you make money on the rental. If you do it right, you can have positive cash flow. Number two, it appreciates in value. You know, whether it's because of inflation or whether house, supply, demand, whatever, it will go up in value over time. Number three, it helps lower your taxes, and so on. And so there's like at least three good reasons right there why real estate is a great way to start investing.
Now, I'll put a little spin on. Well, first make two comments. So I think it's important to know that this show is not going to be political because I really don't think that whether whoever's in power is really going to help you, regardless. So like this, short of saying this is the current fiscal policy and this is how we are going to deal with it, this is not going to be a political show. Like if there's a law, that's the law. Like that is the law. I don't care who put the law there or the policy. Like it is what it is. I don't care who put it there. I just need to know how to navigate it. Like, what is the tide doing? And that will dictate what I do. I don't care who's driving the tide.
Exactly. And, you buy an investment property, you might own it for 10, 12, 20 years, whatever. You're going to have 3 or 4 different administrations during that time, right? So politics should play no part in this whatsoever.
Exactly. And then as far as it being easy, so I will say I'm by no means an expert, but I've gotten a lot better and a lot more clear in my thinking now than I was when I started all of this 10 years ago. And it is simple. You buy a property, ideally you fix it up, you increase the rent, etc., and you just keep repeating this process. However, the analogy that I would use is like boxing. Like anyone can throw a punch, but there are world-class boxers, and then there's like people who have never thrown a punch. Like you can still do it, but it doesn't mean you're going to be good at it. So I think there is something to be said for really studying it. And sometimes it's really subtle decisions or even timing that can make a huge difference on your returns.
Exactly. And I think that's true for just about anything in life. I mean, if you have to choose between 2 mentors, right? One mentor is a PhD who has like been studying it for 20 years, but has never actually done it. Or somebody who's not an expert, like they don't have a PhD, but they've been doing it for 20 years. Make sure you choose the one that's been doing it for 20 years because there's no substitute for real world experience. Like that's what's going to get you through the dark times. That's what's going to get you from point A to point B. It's the real world experience. It's that world-class fighter, right? Not the expert who studies boxing by reading a lot of books.
Yeah. Like I'll say I've read a lot of books. I've listened to hundreds of hours, if not thousands of hours of podcasts at this point on real estate investing. And until you actually start doing it, it is there's that saying, everyone has a plan until they get punched in the face. I think that was Mike Tyson. Like I will tell you. So when we were investing in that airline stock, and it's one thing if it's a little bit of money, but it's different when you've really put a lot of your savings into something on a calculated risk. And then you watch that fluctuate by like 30% in a day. And especially if it drops by like 30%, it takes a lot of nerves to just sit there and watch it and say, nope, this will be okay.
Exactly.
Or you have a property and the tenant is It's a true story. So this is my first investment property. I don't think I've told you the story. So we were very careful. We got a very nice property, very nice townhouse, and we rented this guy who had a good credit score, and I think he was an electrician, and he was divorced, so he just wanted a place for his daughter to stay. So we thought this would be perfect place. 3 months into renting to him, he says, "You know what? I hurt my hand. I'm going to be a little bit late." So I said, "All right, that's fine. Like, you're going to be late. Um, your credit score is good. We'll just let it slide." Another month goes by, and of course, that means I have to pay the rent. Like, just like any business, if I go to the shopping store or grocery store and I want to buy milk, if I don't have milk money, I don't get milk. But being very kind, I was like, "No, all right, you can pick it up on the next month." Then, of course, another month goes by and another month. And he says, "Well, I think you have to go on disability and I'll get a disability check." So then I can get caught up. And then I was like, "Okay, fine. Well, you're a good guy. I feel for you and your daughter that's visiting you. I want you to have a safe place." 6 months go by with zero rent of me covering this mortgage. And I'm just like, this is not a good investment. But I bought in a solid area. The economics of the area were really good. So I knew the house would appreciate, but it's different when you have to pay the mortgage, when you were financially banking on him, on this tenant paying it. And then we got to the end and we just talked to him and he said, "Listen, like, I just don't have the funds. I will never be able to pay you." And we said, "You know what? It is what it is. Just move out. We'll rent it. And I'm not going to, like, it is like bad things happen. I'm just going to let it slide. Go about your day, and then we'll fill it." And that was my good deed of the year.
Yeah. Yeah.
Didn't put him in collections, didn't do anything else. I'm like, this. I'm just going to be like, this is my good deed. And it ended up working out well. Like, the appreciation of the property far outstripped anything I would have gotten from rent.
Yeah. And I think you touched on a good point there is, it all goes back to how much risk can you handle personally. So you had to carry this property for 6 months out of your own pocket, and you could, which means
Mm-hmm.
you know that you have enough cash flows from other activities you have, that if you have a bad tenant, you're going to be okay. Like, you weren't relying on his rent money to buy your milk, like, to use your own words. Like, okay, the goal here is the tenant's going to be good, the tenant's going to pay. But if the tenant doesn't pay for a certain period of time, I'm not going to be happy. I'm going to be out a lot of money, but I'll be okay, right?
And I think that goes back to anyone can buy a property, anyone can rent it out, but understanding, like, how much reserves do you need, having the risk tolerance, there's a lot of little details that you kind of need to know in order to make this work. Like, it's not complicated, but it's not easy, I would say.
Yeah, I agree. And you do need a little bit of luck. So every investment, you
do
need some luck. You need some luck. It doesn't matter if you're buying a house, stocks, airline stocks, options. Like, you need some luck. But I've had a similar situation with so I have one rental property I have is in Pittsburgh, and almost every year, December, December comes and goes, and when it comes to January rent, my tenant can't pay. And I've had the same tenant in there for like the last 2.5 years, whatever. And it's like a pattern. January 1st, can't make rent. And I get it. Like, there's the holidays, Thanksgiving, Christmas, he's got to buy a lot of gifts or whatever the story is. He can't make it. But, the first time it happened, I'm like, well, like, what am I going to do? I mean, so I talked to the property manager, like, let's give him another month or whatever. And sure enough, by middle of February, he paid up and he was, he made whole on it. That's fine. Next year happened again. Couldn't pay in December. January comes and goes. Early mid-February, he pays up. He's paid up. He's good. And I recently refinanced the property. And of course, when you refinance, like, the assessment, the assessor goes in there and takes pictures and does like a formal assessment. And so I saw photos of the property, like, from the inside. And this tenant's been in there for several years now, and the inside of the place looked great, right? And so I'm like, you know what? He pays 11 months of the year, and when he doesn't pay, he pays like 1 month late. That's fine. He still pays. The house is in great shape. He's not destroying it. That's good. Like, you can't expect everything to be perfect, right?
Well, I think that there's a subset of people that would think, oh, landlords are these evil people who or a part of this large corporation and they just want to feed on people. But you could have charged him late rent. I'm sure it's in your contract that you can charge him late rent.
Correct.
But he's a good tenant, so you just let it slide because you know he's going to be good for it.
Exactly. That's exactly it.
I think people forget that at the end of the day, a lot of landlords are just small business people, and this is how they're planning for their retirement. So they're looking for good customers to work with that they'll be flexible with, as long as everyone's respectful. But if someone is not, but if someone just decides to not pay rent, they're actually stealing from you because they're living in something that you could be renting out to someone else to like pay your bills, because you still have to pay the bank. But if they just decide they're not paying rent, really, they are stealing from you. That I don't think a lot of people understand that.
Correct. Yeah. And I think you're right. There's always this, I don't know if you call it like a stigma, or if it's just a culturally popular thing, but like landlords are always depicted as evil people. I think you just kind of hinted that as well, right? Landlords are evil, and the people who are renting are the victims, and that's the mentality that you face. But you're right. Yeah, most landlords are just average Joes who have a day job, right? Like I have a day job, you have a day job.
Mm-hmm.
We have to go to work 9 to 5 to put food on the table, and yeah. I own a rental property, and it makes me like $200 a month. If that makes me evil, then I guess I'm an evil person, Chris.
Yeah, and I think people forget like the margins on owning a rental property, like they're not huge. It's a small profit margin, and most of the money comes from just the mortgage pay down and then the appreciation. But it's not like you're making this ridiculous sum of money by like renting out the house. But if someone doesn't pay their rent, you then have to pull that money out of your pocket and pay for that rent, which is a lot more than $200.
Mm-hmm.
So since this is the first podcast, what do you think is the forecast for the next, let's say, 5 years? Where will we be in 5 years? So we can look back at this podcast and see.
On a personal level, like
Sure.
about like you and I, yeah. So
yeah.
Okay, so right now I'm 43 years old, and it's funny. Like when I was younger, I told my college roommate at the time, I said, "Here's my plan." I was like in my early 20s at the time. I said, first 25 years of my life, I'm just gonna have fun, enjoy my youth. Next 25 years, I'm gonna work like a mofo, and then the last 25 of my life, I'm just gonna kind of take it easy. And so I'm coming up on that second 25 milestone, and so I want to be in a situation 7 years from now, by the time I'm 50, where I'm only working a day job, like 9 to 5, for someone else, if I want to, and if I'm enjoying it, and there is some kind of fulfillment there, not because I financially have to. That would be like a really good outcome for me. And you know what? And if I'm off by 5 years and that happens to me at 55, that's okay too. But that's kind of where I'd like to get to, on a personal level. Your question was 5 years. Okay, so where I'm going to be at 48, I think you and I are going to own a lot more rental properties than we do today. I'd like to be up to maybe 20 or 30 doors at least in the next 5 years. That'd be a really, really good outcome, and I think it's possible. Right now we have one door together. We just started earlier this year.
We can go into the details, but we just started. So Gabe has previously owned, I'll just shout, like Gabe has owned properties before. I've owned properties before. And I feel like we have a very complementary skill set, and we just did our first deal together, which we'll probably get into in another episode, but needless to say, it went well.
Yeah, knock on wood, so far so good. That's our first property. We just bought it a few months back, so that's it. Chris and I together own one door, and I think that's going to grow quick. I'd love to be up to 20 or 30 doors in the next 5 years. I
have to say this because Kristen, my wife, was very instrumental in this as well. So I would be very remiss to not give full credit to her in doing lots of planning. She also did the tile in the renovation. She did the tiling, and she did a very good job.
Well said. Absolutely. She is definitely involved day to day. And so, yeah, I think when I'm going to be 48, I'm going to be already knock on wood, planning out, the next 5-10 years, and following up and living out my dreams of world travel and taking it easy. Because yeah, it's been a long haul actually. It's personal, like work wise and everything. It's been a long haul, and I'm looking forward to taking my foot off the accelerator shortly after 50. Sorry, I rambled a bit there, but what about you, Chris? 5 years.
So I tend to focus and do not a lot of things, but the things I do, I'm just very focused on them. Which has been kind of the theme of so like to get into medical school, you're very focused during undergrad. Like you're not going out and partying, like you're really just sitting in the library, at least I was, and studying. And then medical school, at least for me, is like, it's miserable for everyone. At some point, everyone in medical school is very depressed. That's just how it is. Because you're studying and working really, really hard, and you're just focused on this thing. So I've spent a lot of time just doing medicine, and now I'm switching that focus into just real estate and investing, and ideally businesses as well. There are a few business ventures I think I'd be very interested in. So I don't have a specific goal. I don't want to limit it with a number of properties, other than regarding real estate, I'm going to say a lot.
Awesome.
Because for me, like, let's say you have enough money to stop working. Well, then what are you going to do? Because that's just when you've gotten good at it.
Everyone has, it's funny. It's funny, like everyone has these big dreams of like what they do when they're not working. And then a lot of people actually are just, they're bored, and, they start a business or they go back to work or something just out of boredom. But I don't know, I have my own sort of personal goals on what I want to do and where I want to go. So who knows what's going to happen after, but I want to reach a certain level of financial independence in the next 10 years, let's say, like 7 to 10 years. That'd be really good. And I think right now I'm kind of on track. We'll see how it goes, but yeah. And getting back to diversification we talked about earlier, I have some money in real estate. I have some money in stocks. I just started options trading. I have some money in 401ks, etc. So I think there's a lot of ways for my nest egg to grow. And I can't wait until we get into every single one of those in a future episode.
Well, and I think what we'll also do is it'll be fun, because once we finish a project, then we can kind of do a play-by-play. And then I think it'll be fun to say, well, this is what we should have done differently.
Right.
Lessons learned in the trenches. Mistakes not to be repeated again, because I'm sure there's going to be those in every project.
Awesome. Yeah, I mean, to be honest with you, Chris, I mean, I could talk forever about this. So I think this is probably a good time to end the first episode. And yeah, I can't wait until we do the second one. I think this worked well.
All right. So again, thank you anyone who's listened to this entire podcast. And this is the first one of, I'm sure, many Seed Money podcasts.
That's it. Money Seed.
Money
Chris.
Seed. Thank you. Thank you for correcting me. That's why you have good business partners, to correct you at the end of the podcast.
That's
Excellent.
it.
Yes.
Money Seed. Like,
Money Seed.
Subscribe, follow. All right. Thanks, Chris. I'll talk to you soon.
Sounds good. Cheers.
Thanks. Bye.